Welcome to Fintalk, our fourth podcast brought to you by Calamatta Cuschieri Moneybase. Today we're going to be discussing the Excel Finance bond issue amongst others, so I'm going to jump right into it. There was a new issue, a 50 million bond, secured bond issue issued by Excel Finance in the market, announced yesterday. And I wanted to get your thoughts on the issue.
Yes, another new bond issue approved by the regulator. As you said, 50 million is the size, with a coupon of 5.4%, maturing 7 years, 2031. It is a secured bond by means of a hypothec on the property. Excel Finance is the investment arm of a larger group, which is the Excel Investments Holding. It was formed particularly to raise finance for the group for particular projects. The group, through its various subsidiaries, is principally involved in two main areas of business. One is the property rentals, principally the acquisition and development of a movable property and rental to third parties. And the second is real estate development, principally identification and of real estate opportunities throughout the island. In fact, the proceeds are going to be used mainly for refinancing, development of property throughout the island, various property throughout Malta, and particularly the Gozo, residential properties mostly. In spite of there is no history because it's, as I said, it's the finance arm. The shareholders have great underlying experience in the real estate business, so that should be a comfort to investors as well. So really, one cannot move away from the property sector more. That's another property bond. So essentially, the investors should always seek their advice and not be overexposed unduly to the property sector as part of a balanced portfolio. But it's interesting. I think the coupon is fair for a 7-year bond.
What is the coupon?
5.4%. And it's always a debatable issue, the coupon, as we well know. Jordan can amplify on this. But I think for 5.4%, as compared to recent issues in the market, and the 7-year tenor should be quite attractive to the investor.
If I may add something, Alex, I think it's very important also to point out about the governance structure of the issuer. Obviously, even in international markets, I think more weight as we go along is being given to governance, and having a composition of board of directors with people which are non-executives and form part of the board will obviously amplify governance in a company, and this is something that obviously Excel also took into account. You've mentioned the coupon. Again, this is a 7-year bond. Usually, most of the bonds are 10 years, right? The new bonds. We have seen very few bonds coming with a maturity of 7 years. So the coupon is more reflective of its tenor. Again, as you said, as Alex pointed out, obviously it is always debatable locally, the mechanics of the pricing, the mechanics of how should one price a bond. Having said that, a 5.4% with a 7-year maturity, and given the asset base that the company has, I think that's very important to point out. One of their major assets is basically Q-Hub and Ormi, which already has most of it leased out, right? It's something positive, and let's say ensures that it will, in 2025, immediately start generating revenues through the lease agreements, as opposed to a project which is as yet to be to be started off, kicked off with a couple of other financings.
So the security is property itself?
Yes.
We've got a very strong base of assets, which add to the comfort for the investor as well. So QHub is the main core property.
So these are the same Excel homes? Or they have nothing to do with
No,
Excel homes?
they're separate. That's
That's
a
a
totally
completely
different
different
company.
company.
Yes.
Okay.
They've got Excel housing and Excel trading, the leasing part of the property business. In a way, the core business is diversified, various incomes from various sources, the rentals, the leasing. It's a well balanced company, I think.
I think on the if I'm at something in general on the local corporate bond market, we have seen the local corporate bond market growing exponential over the past year. So today, in issuance, we have around 2.7, if I'm not mistaken, billion of issuance on the local corporate bond market. We have seen a strong wave over the past 5 years.
Mostly oversubscribed?
Mostly oversubscribed. And I think this strong appetite by local investors has pushed many companies to explore other forms of financing. So usually, many companies locally are only financed through bank loans. I think companies and companies' executives are more and more understanding that having a more flexible capital structure, helps the business to grow. But most importantly, it also gives them flexibility in terms of financing. We know with a bank loan, you need obviously to have also repayment of capital throughout. Whereas, for example, one of the advantages with a bond, you pay the interest every year, but you pay the capital at the end of the maturity of the bond. Obviously, issuers have also to understand the needs of investors. Today, investors are being much more selective. You can vouch for this, Alex, because you are more client-facing than I am, obviously. Investors have become very selective. So it is very important that issuers also understand what investors want and structure these issues, in line with investors' expectations. If they're not structured well, the oversubscription that you've mentioned, might be not the case in all issues. And in fact, we had also issues over the past which weren't oversubscribed.
Yes.
Why? Because investors, as I've said, became more selective, and the good companies or let's say the good structuring, will be oversubscribed. Case in point, Bank of Valletta, very recently.
Yes, it was a massive oversubscription. I can't help noticing over here the distinction between the demand for corporate bonds through the demand for Maltese equities. There's a big divide between them, which has to be addressed in some form or manner. But it's a pity because many of the companies are very good companies. They produce good results, good profitability, and yet the demand, because of various reasons, is not there for local equities as against the demand for corporate issues.
If I may, I think one of the reasons for that is the lack of investors' relations. Unfortunately, Malta will lack communication from the issuer to the end investor or from a company.
It is true, Jordan, but just to mention a company which I really admire, which is MIA, for example. An excellent company, profitability on the increase. They went through COVID in a very, very good way, very intelligent way to preserve capital. And yet, in spite of good results and in spite of increased dividends and communication with the investor, which is admirable, still the price does not move. So there's something wrong.
I agree. Obviously, in terms of investor relations, I'm saying if this is when a company seeks financing, it is basically initiating a long-term relationship with investors.
Exactly.
So if a company wants to eventually tap again the local investor base, you need to communicate throughout. And this is something very important that company executives need to understand if they want to have a long-term financing vehicle through the local capital markets. As I said, it grew exponentially, but let's obviously take care to utilize this vehicle as a source of financing, also to grow the local economy. We know that obviously the bond market has helped the economy grow exponentially over the years also, because without any financing you can't grow your economy.
Okay.
But Excel seems to be ticking the right boxes, so I have no doubt that it will
It's
be,
worth
it will
considering.
be oversubscribed as well. Bond issues are available on Moneybase, they're available through advisory, and they're available through discretionary portfolio. So people have the choice nowadays if they want to do it online or if they want to seek advice to see if it's forms part of if it matches their profile and it forms part of their investment profile, if it matches their investment profile. So I think today it's a very good time for investors who wish to earn interest on bonds, because they IPOs, you don't even pay any fees. If you can get advice, you can do it online. So I think it's a good time for the investors to have these kind of bond issues available on the market, and especially locally. So these are companies we know. In fact, what I wanted to ask you was the local bond market versus the international bond market and the price volatility. What do you see? Do you see any differences over there?
Yes, for sure. I think one of the main issue for that is, one, the lower liquidity as expected, because the local market obviously is small compared to international markets. And I think, to be fair also, we have a culture of buy to hold, right? Buy to hold to maturity. And that's something that obviously will mitigate price volatility. I think the perfect example is 2022, when we have seen a strong rise in interest rates following 15 years of very low interest rates. Theoretically speaking, when interest rates move higher, bond prices will automatically move down, move lower. And in fact, in 2022, for example, practically speaking, if we had to look at the performance of US Treasury bonds, US government bonds, these were down on average 17 to 18%. The local bond market was also down, but to a much lesser extent. If I recall well, it was down around 5 to 6%. So there's no right or wrong. Having said that, statistically proven over the past 10 to 15 years, the local bond market was always less volatile than the international bond market. This is obviously applicable both on the downside but also on the upside, right? So again, if we were to look at the past 15, 20 years, if I was exposed, right, to the local corporate bond market in 2022, the downside risk was lower than if I was exposed, okay, to the international bond market, specifically to investment grade bonds, which were very sensitive to the increase in interest rates.
There's another point I would like to raise over here is, and maybe it's sometimes overlooked, is that many of the European Euro bonds are not retail friendly. And that is a bit of a handicap for investors, as against the minimum amount required to invest in local bonds. So naturally, the availability of local bonds takes precedence over the foreign bonds, particularly because of this reason. We have had some exceptions in the last couple of years when we took advantage, in actual fact, of higher interest rates in good companies like British American Tobacco, Imperial Brands, and even some sovereign bonds, which we had taken advantage of, getting a yield of over 5% at that time. No longer available now, but I see it as a big plus for local issues to be able to go into with a minimum size normally of 2,000. You know.
Yeah. You mentioned interest rates. What do you think? Where do you think interest rates are going? Do you think they're going to stabilize? I mean, obviously, you don't have a crystal ball, but you mentioned 15 years of very low interest rates, negative interest rates. Now it's sort of happy days for people who are looking to earn interest, but we've seen steady cuts by the Fed. and obviously that has a ripple effect as well on the global economy.
Yes.
Do you think that, we're going to remain positive, first of all? I mean, let's say in the next 5 years, and do you think that they would stabilize at around 2%? Or what do you think?
In our last podcast, we touched base only on interest rates. And I think to answer your question, if we get to a situation where interest rates move to a negative territory, as we have been, that would be obviously a big issue in terms of economic growth, right? So I think it's very important to point out that apart from interest rate cuts, there were other monetary policies which continued to pressure interest rates lower. Quantitative easing, which obviously in Europe especially, it has pushed yields to lows which weren't justified from a risk-adjusted point of view, right? So personally, I think, and this is also backed by obviously the investment team at CC Moneybase, I think we are seeing yields, interest rates stabilizing. Obviously, with this new Trump administration, the agenda is inflationary. We've pointed this earlier in our last podcast. Having said that, I don't think we will be in a situation of close to zero interest rates again. In fact, if we have to look at banks and what they are earning on interest income, 2023 was a record high.
Yeah.
Having said that, their expectations for the first half of 2024, were lower. But in actual fact, many banks have continued to benefit from the stabilization of interest rates. I think in Europe the situation is slightly different because we continue to see a struggling economy, right? And this is also evident in Germany.
The euro dollar is heading for parity. I was
asked this question this week constantly by an investor or one of our
almost
investors.
1:1.
Yes, that's something obviously very much dependent on monetary policy going forward.
But that's a good thing for people who are invested in the dollar, right?
For sure. So we have seen a spike of around 5%, so from 110s to 104s as we speak. So yes, and I don't think that will revert anytime soon in terms of the euro appreciation. So to answer specifically your question on interest rates, I think yes, we'll eventually see some sort of stabilization.
So people who are locking in US dollar as well, bonds, not only local but US dollar bonds at a good rate, with these rate cuts coming along, should do well, right? Because
this is something ironically that we have been pushing for the past 6 months also as a company to take opportunities of the much wider spreads we can lock from the US, for example. The local corporate bond market, the US foreign bond market is offering very good opportunities in very solid names that can lock a yield of 5.5%. We're talking about investment grade companies here. So yes, as you've said, it is very attractive to not only lock a yield in the US, but also to lock a yield for a longer period. I think that's the trick.
Wells Fargo just issued, so moving on to international markets, Wells Fargo just issued an S&P target for the end of 25 of 7,000. Plus the highest Wall Street amongst the highest Wall Street target. Your thoughts on 2025 and the S&P? I mean, that would mean a 26% obviously increase in 2025.
No doubt. With the Trump administration, there is an aura, a momentum building towards a year-end rally and also a possible very successful 2025. It won't be one straight line up, that's for sure. And there is a parallel being drawn between the dot-com boom and the AI boom, between the builders, I would say, and the appliers of the sector. So we had a revolution when it comes to internet with the dot-com boom, with companies like Amazon and Netflix and Meta and Alphabet and Microsoft all booming away. So now, would be interesting for me would be the application of AI in, for example, other sectors, electricity companies, or other sectors which provide services which are going to be more efficient. More efficient would mean more profits, you know. One particular sector that I was following this week was the electricity sector. The demand for electricity is going to be so huge that all of a sudden what was taboo, nuclear energy, is now becoming the order of the day. And the sector, even through ETFs, and ETFs is a very effective way of investing in particular niche sectors, are booming, are appreciating in a very substantial way. So the demand for electricity would affect, obviously, companies like Iberdrola or any electricity company which is has a wide moat, which is the leader in the sector. But it would be good to identify those companies in other sectors which are going to benefit, not because they are an AI company or a technology company, but because AI is going to prove it, even in medical services, for example.
Even Salesforce, for example.
Even Salesforce, for example. Salesforce, I think Jordan can say a thing or two about Salesforce.
Salesforce is a company which is experiencing the third wave of AI. Okay, we had 3 waves. The third wave is basically what Alex has just pointed out in terms of applicability now, right? So it's used as investing in a project without obviously benefiting ultimately from that investment. And this is something that we have been monitoring for a while with Salesforce. Salesforce has recently launched a very interesting platform called Agentforce, which is basically, as I've said, it is the third wave of AI. The third wave of AI is moving beyond chatbots, right? And basically having literally agents, okay, which can help not only in sales, but also in the execution of those sales. And this is where the company, ironically, because there's a strong demand, in its first week of launch of Agentforce, it already logged 200 clients. So there is an interesting part there for Salesforce. Coincidentally, Salesforce reported its results this week, right? And they specifically mentioned that they're seeing demand for this new offering that they can offer, not only to small companies, but also to the big companies that we've mentioned many times over the years, which are also seeing the applicability taking place, which will eventually improve automatically their margins. And this is where we need to identify now companies that are able to let's say, facilitate, okay, margin growth of companies that we're comfortable with in investing.
In fact, it's a point. I don't think there are, at this point in time in the market, there are any big bargains to be made. It's just the forward guidance that we need to see. And the market, whenever there is the results of a particular company, gives more importance not to the results per se, but to the forward guidance given by the chairman.
For example, if you take Amazon, they announced that they're going to be producing chips to compete with NVIDIA. So that's a forward-looking focus.
Then, obviously, the market assesses the possibility of that happening. But with big companies, they normally have the deep pockets to be able to fund all these. And I think at this point, we are now getting to, as I said, to the applier stage of the AI boom, and the identification of those companies which will help the AI boom is going to be essential, and I think it will be essential for them to be part of one's balanced portfolio, no doubt.
Yes, a very important point on Amazon, because you've asked about one. So Amazon have launched this new chip, which is Train 2, right? Train 2. It is very interesting because we know that NVIDIA generates 6% of its revenue from Amazon. In aggregate, it generates 40% of its revenues from Amazon, 6% from Amazon, 15% from Microsoft, Alphabet, and Meta.
So is Amazon going to continue buying NVIDIA chips?
That's the question that one should
Exactly.
pose. So, interestingly enough, Amazon has continued to seed a startup, Anthropic, okay, with a new investment of around $8 billion, which will eventually, as you've said, probably will be less dependent on NVIDIA, okay? And that's something interesting on how one should look today at NVIDIA. NVIDIA reported its results. I remember that we've discussed this briefly in our last podcast. It had very good results. It has beaten expectations both in terms of earnings per share, but also in terms of revenues. But I've also recalled discussing the rate of growth. For the first time, NVIDIA in the last 7 quarters has forecasted a slower growth than what the market anticipated. So the 90% growth, okay, that NVIDIA used to report has now slowed down to around 59%.
Yeah.
And this is something that we've discussed last time, as I said in our last podcast, and this is where we need now to identify other companies, okay, which can continue to grow accordingly. Again, we're not saying that NVIDIA is not a good company. NVIDIA will have always the first mover advantage.
But are you still holding NVIDIA?
We have, yes, NVIDIA
Okay.
again with this new chip that will be launched, which is the Blackwell chip. Okay, it is 30 times faster than its current offering. Okay, something that unfortunately the market ignores is basically how dependent is NVIDIA in terms of producing the chip. And in fact, NVIDIA, that was also pointed out in their last results, is their dependency on companies such as Taiwan Semiconductors to basically produce these chips. And despite that the market can move the price of NVIDIA higher, the tangibility of ultimately seeing those numbers in actual fact, okay, might be conditioned by supply issues, for example. So this is something that, unfortunately, the market at times disregards, and what we call in economics, the animal spirits kicks in terms of emotions and buying NVIDIA because other people are buying.
Okay. Moving on, the last 2 questions, I have to talk about Bitcoin, even just for a bit. Money keeps on flowing into the Bitcoin ETFs. There are also the Ethereum ETFs and Solana ETFs. Now physically backed as well, with quite low management fees, obviously, because they want to attract AUM. So basically, investors are getting an exposure over there. We get a lot of questions of interest. Listen, should I get exposure and how? Do you have any thoughts on this, just to cover it?
Well, with the Trump administration so pro-crypto, in fact, the 2 members on the Securities Commission, which were dead against crypto, putting, like, let's say, spokes in the wheels, have now resigned and been replaced by avid pro-crypto people. You cannot ignore the inflow of funds into crypto, and with Apple saying we'll accept Bitcoin with the Apple Wallet and Apple Pay, with Walmart doing the same, it's going to change. It's going to change. What was wrong about crypto is the lack of legislation. With now, even the UK has not just announced, the EU has just announced legislation going to take place. And it's good, because we don't want crypto to be a Wild West territory for investors.
And there are new ETFs coming along as well.
And I think the most effective way of having part of your portfolio, should one want to have that exposure, is via ETFs. There are tracker ETFs. There is physically backed ETFs in the main ones, in Bitcoin, Ethereum, Solana. Now possibly XRP has applied to the Securities Commission to be listed. So it's just as the iWatch and the mobile changed and revolutionized the whole world because we actually lived through a revolution. I think this is another revolution in the making. The way we see the digital currencies, and after all, let's face it, the EU is already making plans for a digital currency, an EU digital currency as well. So the idea of having digital currency is not now gaining track, no doubt about it.
And it would be great, obviously, to have it decentralized, because the digital euro, the idea, from what I can understand, is that it's going to be centralized at the central bank. And the contrarian view is obviously that we want decentralize, that we don't.
Yes.
Maybe the consumer does not want the central bank to control the currency, that we want it decentralized. And that not everything has to pass through the central bank. So there is the digital euro coming up on one side. But at the same time, there was MiCA that is powering
it's a big debate.
digital currencies and digital assets. So it would be interesting. But at this point in time, I think Bitcoin is being seen as a sort of like a digital gold, where since it has a finite, there's a finite amount, people are parking cash over there. Okay. So last question, we're in December. Your expectations and maybe your picks for 2025?
I think, first of all, from a regional point of view, I think in 2025, it would be a very difficult year in terms of fighting, a battle against U.S. equities.
Yes.
So this new administration, is undoubtedly pro-growth, and not being exposed to U.S. equities, will obviously be reflected in performance. We have been seeing this for the past 15-20 years now. So the only period when the European market outperformed U.S. equities was in the last quarter of 2022, first quarter of 2023. Other than that, U.S. markets continued to pop up. And as I've said, not being exposed to U.S. equities will be obviously a big mistake, especially with this new administration. Eventually,
just to add on to what you're saying, I mean, there are different ways how you could get exposed to U.S. equities. I mean, you can build your own portfolio, have a discretionary portfolio, but you can also go into ETFs, or you can go into equity funds, right?
Yes, obviously, it is about what you're after for in terms of your investment objective. Very importantly to point out, Alex earlier also mentioned, it is about how would one structure a portfolio given the high levels, the record highs that the markets have touched recently, yesterday.
Yeah.
And in fact, we are approaching the situation in two steps. First step is basically starting to build a position in December, January, and up to eventually the inauguration of Trump as 20 January as the next US president. After that, it is about show me the money situation. Why? Because it's about a situation where Trump will start rolling out the policies. And this is where we are adopting what we call a core satellite approach. Why?
I think it's going to be a bit volatile, obviously.
That's why. So what we will do, what we are doing in terms of our structuring, of portfolio structuring, is having the core names, which will always form part of our portfolio. We've mentioned these names many times, Alphabet, Amazon, etc., right? But then you use the satellite bit, right, to actually take opportunities of the volatility you've mentioned, And believe me, there will be opportunities in terms of volatility. We have seen this happening. We have seen also this happening after Q3 results. We've mentioned Meta, which was down 6-7%. Yesterday, Meta touched an all-time highs, right? And this is where the satellite bit of our portfolio will take opportunities of these volatilities.
A recent example was Mercado Libre. After the results, 16% down. It recovered everything because the core business was there. Mercado Libre is considered as the Amazon of the South Americas. A good, solid business, good growth, a growth story. I think it's something to simply buy and hold and leave it for the longer term. We've had Palo Alto, the same, producing results which were good, statistically good. The market was disappointed that it did not beat the expectations, and yet then it just simply recovered. Volatility means opportunity to me, because when it's oversold and when the reaction is so violent that it doesn't make sense, that is where you have to sit down, reason it out, and hit it. So volatility is not really bad for the market. It provides opportunity.
What surprises me is that, for example, someone like Warren Buffett still has a lot of exposure to Apple and Coca-Cola.
Coincidentally, I've shared internally this week Warren Buffett's portfolio. And as you were saying, there's a high stake in Apple, high stake in Bank of America, okay? A smaller stake in Coca-Cola, but it's still...
even though he offloaded Apple.
Even though he offloaded
but
Apple,
still
but also
the main...
Bank of America. But the approach, I think, is more different there in terms of long-term value creation. For example, an interesting exposure which Warren Buffett has is Moody's. Moody's is a company that constantly, I think we've mentioned also in the last podcast, we are exposed to Moody's, which would continue to benefit, one, of lower rates, but also of Trump being more open in terms of financial markets. What I wanted to add also from a macro point of view are basically two micro data points. The International Monetary Fund is saying that in 2025, growth in the US will be 2.2%. In Europe, in the Eurozone area, it will be 1.1%. Looking at corporate profits in the US, expectations for 2025 are 14%. In Europe, it's 8%. So not having a skewness towards US equities, I think, will be reflected in performance.
So
okay?
adding one other question that I'm thinking at the moment as you're talking, the global asset, the global fund that you're running, what is called the global
Opportunities.
there's the global opportunities and the global balance.
Fund.
The global opportunities fund is pure equities, right?
Yes.
And the global balance is a mix between bonds
It's a
and
multi-asset
equities.
fund. Yeah.
What are you doing on the global balance? The global balance has performed well, right?
The global balance, yes, continues to have a strong performance over the past 5 years. What we've did, we have a 50-50 allocation or thereabouts, 15 bonds, 50 and equities. But as I've said, our skewness in the 50% allocation to equities is US. And
So you've kept it 50-50, but
Yes. Yes. But we are managing the 50% in equities in that portfolio, or thereabouts 48-50%, right? With the approach that I've just mentioned, which is the core satellite approach. So we have the companies, but then we have the opportunistic plays that we take, okay? When there is a correction, there are numerous names that we open positions in. We've mentioned a lot. We've mentioned Uber. We've mentioned financials such as Fiserv. We've mentioned companies such as Mercado Libre. So these are the names that will obviously help in terms of performance. But the skewness to the US, I think, is imperative, even moving in 2025.
You think Uber is going to end up using Teslas for their robo-taxis, or?
Ironically, there is this inverse relationship. When there's something announced by Tesla in terms of robotaxi, Uber is down 6-7%. In actual fact, if we've had to quantify, okay, the impact of the robotaxi on Uber, it's minimal. So when Uber is down 6%, 7%, okay, one should take the opportunity and open a position. Why? Because Uber is generating over 3 billion, okay, free cash flow today, okay, in 2018.
So it's profitable.
3 billion of free cash flow every year. And that should continue to grow accordingly.
Lyft did not follow the same course, right?
Yes, but it is growing also.
It's also growing.
It is also growing. The interesting about Uber, their agile business model in adapting and investing also through acquisitions, which will obviously help them not only mitigate the robotaxi or any other threats, but also in generating a business model which has higher margins as opposed to today.
I mean, it could be. I mean, I don't know if Tesla's model is going to be direct to the consumer or also, I mean, Uber could be a great customer of Tesla as well.
Probably yes. It
So-
was also floated as an idea in a couple of articles which I was reading throughout. You've mentioned Tesla. We'll continue to see since our last podcast Tesla moving up, and I think this is something I've mentioned before in terms of animal spirits. Elon Musk got a formal appointment, and this is why
Yes.
one of the reasons why Tesla continues to.
And
move up.
I'm seeing some analysts and some fund managers taking exposure there.
But my question is, are they taking
not
exposure
a main exposure, but sort of saying,
because there is a fundamental view, or because
both.
it is a momentum trade? Because if I remember very well.
No,
when-
because of the unexpected closeness of Trump and Musk, and because of it was unexpected that sort of Elon Musk obviously is going to be in such a good position, which is obviously going to benefit Tesla. So I think
Yes.
that is the
Mhm. The problem is the fundamental view, because I agree with you from a momentum point of view, but fundamentally I also remember that when the market realized that the auto business of Tesla is moving constantly lower versus its market capitalization, we've seen big corrections, 30%, 35% in Tesla. And this is something that we need to monitor going forward.
Time will
I
tell.
think there's
Time
more
will tell.
momentum. I think there's more momentum on Tesla, and with Elon Musk's appointment, the 1+1 make 2 is going to be favored in many forms and many sizes. Hopefully, the relationship will mature. But
he's a bright man and he rarely loses. I mean, I don't think it's a
He's
good
a
idea
better.
to bet
yes,
against him.
one company,
with
XAI,
Starlink,
is now, but it's solely available for multi-billionaires and wealth funds and
for
whatnot.
investors.
I'm looking forward to, Christmas has come early this year, so normally there's a year-end rally in the market, which I think will happen.
It happened sooner this year.
It happened sooner, but one mustn't be carried away. Fundamentals, as Jordan very rightly pointed out, are essential
Especially,
in any choice of company.
I would say especially if you have your own individual holdings and you're stock picking versus going through an ETF or a fund, where obviously the timing then becomes more crucial because there's bound to be a correction at some point.
Yes, but to make it easier, it's if you're quite convinced that a certain sector is going to benefit, an ETF is there for you to invest in, and you don't have a sectorial ETF, whether it's housing or pharmaceuticals or industrials or I don't know nuclear or I don't know what. There are all the ETFs. Which are available. Obviously, with the help of your advisor, then you pinpoint one of the best that there is.
From my side, I think timing the market is probably the worst thing you can do, right?
It's not about timing the market, but the time in the market that will eventually will
time, long-term
Yes.
value. Thank you very much, and we'll see you next time.